Hi there, thanks for tuning in. This is the next episode in our series looking at the income statement, and we're following up from operating earnings, looking now into income before taxes, or also can be called other income and losses. And this can be broken down into multiple different segments. The most common one you'll see is interest revenue and interest expenses. Interest revenue simply represents the earnings that companies are getting from interest in certain accounts. When you have money in a savings account, you get a little bit of interest usually to compensate for you holding your deposits there. The same thing applies to companies. Usually they get a little bit of interest for holding cash with a financial entity. And other financial instruments will also contribute to interest income if they're held by this company. They can invest in bonds and certificates of deposit, even in equity for other companies. And if these financial instruments give them any revenue, then they have to put that into their income statements. For most companies that aren't related in the field of finance or insurance, this should probably be a pretty small portion of their income. That is to say, you shouldn't really expect interest revenue to be greater than just their regular revenues from their day-to-day operations, but it's still an important item to consider because it contributes to the total income a company has. We also have interest expense. The name is also pretty self-explanatory, but it simply represents the interest accrued from the funds they have borrowed. Notice that I said accrued here. That means that they haven't necessarily paid down this debt yet. So if I, as company A, for example, have a $100 loan at a 4% interest rate and I've had it for a year, well, that means I will have an interest expense of $4. It doesn't matter how much of those $4 I've paid down. If that is the total amount I've accrued and maybe I've paid down $2, my interest expense is still going to be $4. The paying down and borrowing of debt is going to be covered in the balance sheet rather than in the income statement. And if we grab the interest revenue and the interest expense and add them together, we take the total gain or loss from interest. Usually companies that have a large amount of debt will have a larger interest expense and thus will have a total net loss from interest. However, usually we're talking pretty small numbers here. If a company's interest expense is absolutely massive, larger than revenue, then there's some serious problems there. Another item to take into consideration that can be another income or expense is foreign currency exchange rates. That is to say, if I'm a company based in Canada, but I do a lot of business in Japan and I have a lot of Japanese yen, I usually want to convert those over into Canadian dollars. However, depending on the exchange rate between the Japanese yen and the Canadian dollars, you may actually incur a certain loss or a certain profit from the exchange rate at that given time. And thus these items are usually noted on the income statement because at the end of the day, there is some fluctuation that you can see based on how these currency exchange rates go. This is incredibly important to note for companies that are maybe registered in one country, but do a significant amount of business in a different one with a different currency. And thus this item can also be positive or negative depending on the context. Lastly, we also have extraordinary items that can also be an interest or an expense here. These are usually one-time things that happen and just have to be listed here because obviously it's a given income or expense. And to give a concrete example, we're going to look at the annual report of Starbucks in 2022. Here they have a line called net gain resulting from the divestiture of certain operations. It's a mouthful. And in 2021, they had $864.5 million in income from this item. What does this actually mean? Well, in 2021, they divested from an investment they had in a Korean operation, and that means that by divesting or selling that part of the investment they had, they received income from it. So they earned from this one-time thing, because it's not going to happen in subsequent years, $864.5 million. So this is important to note. These one-time things can significantly affect numbers, and you cannot expect these numbers to carry over to subsequent years and financial results. So adding all of these different things together, interest earnings, interest expenses, foreign currency fluctuations, and extraordinary items, we're going to get what is called earnings before tax. I'm going to leave it here because next episode is our final one in the income statement where we will be looking at net income. So if you made it to the end of the video, thank you so much for watching. Please keep watching this series, and then after this series where we cover the income statement, we will be covering the balance sheet. And while I'm here, if you're interested in investing, I can actually recommend you use Webull as your broker. Webull is a commission-free broker that I have found to have a pretty friendly user interface, to be really fast, and all in all, I've had a great experience with them. And if you sign up with them, they usually give away free stock for people who are first-time users. So it's pretty risk-free return for you, and you can sign up using the link down in the description. So with that said, I thank you so much for watching. I hope you keep watching and you subscribe if you want to see more videos like this. and please have a great rest of your day.